Hello students, myself Dr. Pratibha. I'm an assistant professor in Department of Management, LLDIMS. So today we are going to discuss one of the topic of finance, that is capital budgeting decision. So before we proceed, suppose you are the manager of a company and you are having rupees 10 lakh in your hand. Then what will you do? Would you invest in a new project? Would you expand your business? Or you purchase a machinery? So these types of decisions is known as the capital budgeting decision. So capital budgeting is the process of evaluating and selecting the long-term investment project that are expected to generate the future returns. It basically includes the three types of things. The first one is the decisions of the capital budgeting are the long-term in nature. The second is it involves the huge amount of expenditure. And the last one is these types of decision is difficult to reverse. Why it is difficult? Because it include the huge amount of expenditure or huge amount of investment. And if we are doing these investment in a wrong project, the overall working capital of the company will finish. So the importance of capital budgeting is it helps in increasing the profits. Basically, there are two types of objectives of a business. The first one is sales maximization and the second one is profit maximization. So whenever we study the capital budgeting decision, our first and foremost objective is how to maximize the profit. The second important concept of capital budgeting is efficient use of resources. As I told you earlier, in these types of decision, huge amount of investment is involved. So we will critically evaluate and then investment in the particular project. And the last one, it support the long-term investment projects. Like we are doing investment for the long-term aspect or for the long-term nature. Okay. So now coming to the most important point of capital budgeting decision is the time value of money. Now, what is it? So time value of money is nothing. It is the sum of money that has a greater value today than it does in the future due to its potential earning capacity. Whenever we study the time value of money, the basic components are future value and the present value. So present value is the current value of future sum of money. Like how much do I need to invest today to get a certain amount in the future? In the same way, what is future value? So future value means how much will my investment grow into the future, right? So the concept of time value of money lies in the three main backgrounds. The first one is inflation, the second one is opportunity cost, and the last one is risk and uncertainty. Moving forward to the capital budgeting techniques. So basically, we can distinguish the capital budgeting techniques in two broad criteria. The first one is traditional method and the second one is modern method. When we study the traditional method, the two implications are there. The first is it is known as the non-discounting techniques, and the second one is it does not consider the time value of money. On the opposite side, we are talking about the modern methods. So modern methods are those methods which consider the time value of money as well as it discounted the cash flow as per to the future income. So we'll discuss one by one. The first method is payback period method. So payback period method is that method which determine in how much time the amount of inflows will recover, or in how much years the amount of investment will recover. Let's say, for example, the cost of the machine is rupees 1 lakh and the annual cash flow is rupees 25,000. So as per payback period, we are using the formula is initial investment divided by annual inflows. So as per this example, initial investment is rupees 1 lakh and the annual cash flow is 25,000. So in 4 years, we will get our investment will be recovered. So this method, as I told you earlier, ignores the time value of money. The second method of traditional technique is accounting rate of return method. And the basic formula for calculating the accounting rate of return is average profit upon average investment into 100. Let's say I am having a profit of rupees 20,000 over a 5 years, and the average profit is rupees 4,000, and the investment is rupees 40,000. So the accounting rate of return is 10%. So this is how we are calculating our capital budgeting decision as per the traditional methods. Now, moving towards to the modern method of capital budgeting technique, and the first method is net present value method. Net present value method is that method which discounted the present cash flow as per the discounting table. So, the NPV accounts for the time value of money. If NPV is greater than 0, the project is accepted. Let's say, for example, if we are having an investment of rupees 50,000 and the expected inflow after 1 year is rupees 60,000 and the discounting rate is 10%. So the first step under net present value is we will convert our expected inflow as per the discounting rate, that is 10%. So the present value of the inflow of 60,000 is rupees 54,545 rupees. So how do we calculate the NPV is the present value of cash inflows minus the cost of the investment. As per this formula, our present value of cash inflow is 54,545 and our initial investment is rupees 50,000. So as per NPV method, the answer is 4,545, that is positive. So we will accept the project. So basically there are three criteria of net present value method is if NPV is greater than 1, we will accept the criteria, we will accept the project. And if the NPV is less than 1 or less than 0, then we will reject the investment. So at last, we will discuss some questions with you. And the first question is, which method is also known as the benefit to cost ratio method? So the answer is profitability index, because this index will tell what will be the advantage and what will be the cost. And if it is positive, we will accept the project. The next question is, which technique ignore the time value of money? So as I told you earlier, our traditional methods, which comes under the payback period method and accounting rate of return method, these two methods does not consider the time value of money. And the last question is, if NPV is 0, should the project is to be accepted or rejected? So the answer is yes. It means the project earns exactly the required rate of return. So definitely an investor will accept the project. So at last, what are the points which we are discussed is capital budgeting. So capital budgeting involves large, long-term and irreversible financial commitments. The second point is TVM, that is time value of money. It reminds us that the timing matters as much as the amount of cash. Next is PBP, that is payback period. It is simple, but it ignores the time value of money. The next is MPV. It is the most theoretically sound method for making the project decision. And the last one is ARR, that is accounting rate of return method. It uses the accounting data for its calculation. Like it uses the profits for the calculation, which is easy to find out, but does not track the cash timings. So these are all about our capital budgeting techniques. Thank you so much.